All right, everybody, welcome back to another video here on Financial Friends. Today, we are going to be discussing McDonald's stock. The restaurant you all know and love. We are going to be discussing their stock, why I have it in my dividend portfolio, and why I think it will continue to be a good position in that portfolio. So without further ado, Financial Friends is a community of people who love business, finance, and investing. If that is something that you're interested in, join the friend group here on the YouTube channel and on all of the other social platforms as well. I am Brendan. I run Financial Friends for you, the community. So hit subscribe, support the channel, and let's go ahead and grow this friend group. All right, into the video. So McDonald's, why do I even own it in the first place? Well, I have this thing, I've talked a lot about it here on YouTube and on other platforms as well. I love to gamify some of my investments. I like to make them a game, have some form of real world action that then triggers an investment in the stock. And for McDonald's, that is driving by a location. McDonald's at its core is a real estate company. They actually own a lot of the properties and then lease them or franchise them out to different franchisees, and those franchisees pay them. We're going to discuss that more in a minute. However, that is its kind of core business, if you will. And because of that, I thought it would be a good idea to invest $1 every time I drive by a location. That, of course, became very costly very quickly, and so I had to scale it back to 50 cents. But nonetheless, I've built a $166 position. I'm up 7%, all time, and own 0.61 shares, hoping to get that up to 10 at some point over the course of this gamified investment. Now, the reason I feel so comfortable and the reason I was really interested to begin this investment in the first place is this right here. McDonald's is the largest fast food chain in the world. Now, yes, there is Starbucks. I also own Starbucks and invest every time I drink there, but of these natural restaurant style brands, like Starbucks is a restaurant, but of course they do a lot with drinks and beverages, mainly in coffee. But McDonald's, you have Chipotle, Yum Brands, Restaurant Brands International, Darden, Domino's. McDonald's trumps them all. And in this image here, I posted it back on September 5th, you can see that McDonald's market cap at $189 billion back then trumped all of these other restaurant brands combined with a lot of room to spare. McDonald's is a global massive brand. And because of that, I feel very comfortable placing some money into this company over time and allowing the company to do what they do best, which is generate a ton of cash and return it to their investors and continue to grow the brand. Now, of course, we spoke about this business model, the way that McDonald's does business, the way they're able to generate such large profits, and it comes back to the fact that they leverage franchising. They allow these owners to come in to get the McDonald's, and they then have to pay franchise fees and a portion of their revenue back to McDonald's, but they also have to pay rent. They have to lease the property back from McDonald's. And because of this, the revenue, the McDonald's generates from these franchisees, they get to keep 82% of it. That's what is highlighted here on the screen. Now, of course, McDonald's does own and operate some of their own locations, and of those locations, they keep about 16% of the revenue, but 82% profit on that revenue is fabulous and allows the company to generate a lot of profits in a business that normally isn't super profitable. You can see here on the actual McDonald's chart, we'll check out their grade here in terms of the dividends. This is the dividend tracker. If you're interested in joining this platform and getting access to this type of things, you can check the bottom link in the description. It is a sign-up code. It does give me a kickback if you hold the subscription, and I really do appreciate the support if you decide to go ahead and use it. It is a fantastic tool. Now, you can see here the dividend grade of 77, which is really good. A little bit higher of a dividend payout ratio, so of the income that they are bringing in, they're paying out a relatively large portion of that. They can kind of afford to get away with that because it's again, relatively stable business because of that real estate aspect. But the free cash flow payout ratio, 55%. We like to see that. Net debt to EBITDA, it's a little bit large, but we also get really good marks here on current ratio, earnings per share growth, dividend growth rate, which is actually a little bit higher than that 6.51%, a 2.21% dividend, and the consecutive dividends paid all pass with flying colors. Now, diving into a little bit more of the specifics, I want to head back to this About tab here and take a look, the Summary tab, and take a look at some of the statistics that I kind of like to look at before getting in too deep into a stock. That would be outstanding shares, revenue growth, and net margins. We can see the margins here actually increasing over the last couple of years. And my assumption is as we've moved towards digital and delivery and these other type of platforms, McDonald's has been able to automate some of their in-store services. You don't see quite as many people at the front. You see those machines now. So this has been able to help with those net margins, and revenue growth. It decreased a little bit even before the pandemic and into the pandemic, but it looks as if it's starting to come back. Again, digital and online, I believe, is truly, truly helping that. And the McDonald's Rewards app returning some of that value to the customers, that's going to drive a lot more business. Now, the outstanding shares, we like to see those going down. It means the company is buying back the stock and your position as a shareholder is actually increasing. That tends to be the case here. Now, why I brought this whole entire video up, why I felt it was important to discuss it, is because of two things that have happened very recently. One, McDonald's beat on earnings, and how that translates into their 10% dividend hike and their position moving forward with a very challenging macroeconomic environment. You can see here earnings per share beat $2.68 versus $2.58 expected, and revenue beat as well, $5.87 billion versus the $5.69 billion expected. They had third quarter net income of $1.98 billion, and while net sales did fall over the recent quarter, excluding any foreign currency, it actually did go up. So because of the fluctuations in currency, really revenue actually rose 2%. We saw same store sales worldwide grow 9.5%, which really beat that 5.8% growth that was expected. And here in the United States, same store sales, that is very difficult to say fast, increased 6.1%. Now, menu prices, it also says here, were up 10%. And that is why I wanted to bring up this topic. You take McDonald's, a business that is, of course, normally cheaper to eat out at, and you factor in trade down. And what trade down is when consumers decide that they no longer want to purchase higher tiered premium products. Maybe that's Olive Garden. Maybe it's Texas Roadhouse or Cheesecake Factory. Where do they normally fall back to? McDonald's. Maybe someone who was eating out every single day at lunch and they were getting, Domino's pizza or something that was a little bit more expensive. Olive Garden, doing DoorDash. Maybe they're now running to their local McDonald's. And despite the fact that McDonald's might be losing some customers that are on the lower side of that income scale, maybe they're making sure they're getting back into the grocery store, maybe they're making sure that, they're just cutting costs across the board, and eating out is not something that they're going to be including in their budget moving forward, you're going to see the trade down from higher tiered, we'll call them, restaurants like, again, Cheesecake Factory, Texas Roadhouse, and others. And with that trade down, although you're bleeding on the bottom end, you're bringing in more customers from that top position. And customers that were even above that or sitting at that level, they're not returning to Cheesecake Factory or Texas Roadhouse or other restaurants, but they are returning to McDonald's. And so McDonald's is perfectly positioned in this trade down moving forward as we get closer and closer to this poor economic time that we are expecting. And because of that, McDonald's is able to reward investors with a 10% dividend increase. We love to see shareholders get paid back, that including me. I love to get paid back from these companies, and McDonald's is doing that again with a 10% dividend increase, bringing that quarterly dividend to $1.52 per share. This is fabulous. We obviously love to see it. And now that 5-year dividend growth rate, as I mentioned earlier, up to 7.3%, and the increase in the dividend for the 46th consecutive year. So that's why I hold McDonald's. It's a strong company with real estate driven sales that they're able to capitalize off of despite any fluctuations in burger prices. And of course, with inflation hitting everybody and their prices rising as well, they are benefiting from that trade down in the consumer because they sit perfectly in the chain of restaurants. So we might be seeing health conscious trends, but McDonald's is a staple in America and Could you picture in America, or really a world where McDonald's does not exist? I personally could not. So comment down below, do you invest in McDonald's stock? Do you like the stock? Are you invested somewhere else in the food or beverage restaurant industry? Let me know in the comments. And as always, have a great one. Take care.